On the morning of January 7th, 2026, something fractured inside the silver market that no research desk at Goldman Sachs or JP Morgan had publicly anticipated, and the tremor wasn't visible on your brokerage screen because the fissure didn't start with a number. It started with a logistical impossibility that forced every major bullion bank to recalculate their exposure in real time. During the first 7 trading days of January, precisely 33.45 million ounces of physical silver were physically withdrawn from COMEX-registered vaults in New York, representing 26% of the entire available inventory vanishing in 168 hours. And what makes this withdrawal historically unprecedented is not the volume alone, but the velocity and the identity of the entities demanding delivery, because these were not speculative hedge funds closing positions or mints restocking seasonal inventory. These were institutional counterparties, central bank proxies, and sovereign-linked accounts that had never before exercised their contractual right to convert paper claims into metal. And the moment those vault doors swung open, the entire architecture of price discovery in the silver market began to operate under rules that hadn't been stress-tested since the Hunt brothers crisis of 1980. The technical level everyone is whispering about in private wealth management circles is not a Fibonacci retracement or a moving average. It is the $65.53 to $65.98 range that silver decisively breached on January 12th. But that breakout is a symptom, not the disease, because the real threshold that changed everything was crossed when 1-month silver lease rates spiked to 6.7% in mid-December from their typical range of 1% to 2%, a pricing signal that translated into plain English means the bullion banks that have historically supplied metal to settle futures contracts were suddenly charging emergency-level interest rates to lend silver, the same way a regional bank charges loan shark rates when its reserve position is collapsing and it needs to attract deposits immediately to avoid a capital call. What you need to understand about silver is that for 45 years, it has traded inside a structure where 97% of the volume was paper contracts that never resulted in physical delivery, a system that worked flawlessly as long as everyone agreed to play by the unwritten rule. You can own as many contracts as you want, but you must never, ever ask for the actual metal, because the moment a critical mass of holders demand delivery, the clearinghouse discovers it has sold the same ounce of silver 20 or 30 times over in different contracts, and that realization forces the entire derivatives chain to reprice overnight. On December 29, 2025, physical silver bars in Tokyo were trading at $130 per ounce, while COMEX spot prices on American trading screens displayed $72, an 80% premium that represented the largest decoupling in precious metals history. And similar dislocations were confirmed in Dubai, where dealers in the gold souk were paying $165 to $170 for silver bars, while Western futures markets insisted the fair value was half that figure. And this wasn't a temporary arbitrage opportunity that high-frequency traders could exploit. It was a structural bifurcation between the paper market where banks settle in cash and the physical market where manufacturers, jewelers, solar panel producers, and now sovereign buyers were competing for a finite supply of metal that could not be printed, rehypothecated, or synthetically created through derivatives. The technical breakout above $65 triggered every momentum algorithm on Wall Street to go long. But the real story is that silver entered what institutional traders call price discovery mode, meaning there is no historical ceiling, no resistance level, no technical chart pattern that can predict where equilibrium will be found, because the market is now discovering in real time what the price of silver actually is when the people holding paper contracts start asking for delivery at scale, and that discovery process is violent, disorderly, and utterly indifferent to the forecasts published by Bank of America or the consensus estimates compiled by Bloomberg. Here's the mechanism that almost no one outside clearinghouse operations understands, and this is where the stakes for your retirement account shift from theoretical to tangible whether or not you own a single ounce of silver, because the leverage embedded in the COMEX silver futures market operates through a fractional reserve system nearly identical to commercial banking. When you deposit $10,000 in a regional bank, that institution is legally permitted to lend out $9,000 of it and keep only $1,000 in reserve, and the entire edifice functions smoothly until depositors start asking for their money back simultaneously, at which point the bank either borrows from the Federal Reserve discount window, raises interest rates to attract new deposits, or closes its doors and triggers a cascade. The silver market works the same way. Bullion banks and authorized participants sell futures contracts representing 5,000 ounces of silver each, collect margin payments from speculators, and assume that 97% of those contracts will be rolled forward into the next month or closed out in cash without anyone ever demanding the physical metal, so the banks only need to maintain a small fraction of actual silver in registered vaults to cover the outlier cases where delivery is requested. That model worked seamlessly from 1980 until December of 2025 because the participants were either speculators trading price movements or commercial hedgers like mining companies who wanted to lock in prices. But in January 2026, a new class of buyer entered the market, one that the risk management models at JP Morgan and Scotia Mocatta had not anticipated. And these were long-term holders who understood that silver's role in the energy transition, in photovoltaic solar cells, in electric vehicle components, in military applications, and in 5G infrastructure made it strategically irreplaceable, and they weren't interested in cash settlement or rolling their contracts forward. They wanted the metal in their vault in Singapore or Zurich or wherever they were domiciled, and when 33.45 million ounces walked out of COMEX warehouses in 1 week, it represented not just a withdrawal, but a vote of no confidence in the paper system, a signal that sophisticated players had concluded the ratio between paper claims and physical inventory had become untenable. The bullion banks faced a binary choice. Either buy physical silver in the spot market to cover their short positions, which would send the price parabolic and trigger margin calls across the derivatives book, or negotiate with contract holders to settle in cash at a premium, which would formalize the two-tier market and destroy the fiction that COMEX prices represent the true value of physical silver. Both options are catastrophic for the bank's balance sheets, which is why lease rates spiked to 6.7%. That was the interest rate required to convince existing holders of physical silver to lend their metal to the banks, so those institutions could make delivery without buying in the open market. And even at that emergency rate, there weren't enough lenders willing to part with their inventory, which tells you everything about how tight the physical supply actually is. The second layer of vulnerability that almost no commentator is addressing is the synthetic short position embedded in exchange-traded funds, particularly the ones that claim to offer investors exposure to silver through shares that supposedly represent physical ounces held in trust. The fine print in the prospectus of several major silver ETFs includes language permitting the fund to settle in cash if physical delivery becomes impractical. And impractical is a legal term of art that gives the fund manager discretion to decide when logistical constraints justify converting your metal-backed shares into a cash payment based on whatever price they deem fair. And if you are holding a silver ETF in your brokerage account, assuming it represents a claim on physical ounces stored in a vault in London, you need to read the prospectus again, because in a genuine delivery squeeze, your shares could be forcibly redeemed in cash at a price far below what physical silver is trading for in Tokyo or Dubai. This isn't conspiracy speculation. It is exactly what happened in the nickel market on the London Metal Exchange in March of 2022, when prices spiked beyond the clearinghouse's capacity to handle margin calls, and the exchange simply canceled trades, halted the market, and retroactively repriced contracts to bail out a Chinese metals tycoon who was short. And if the LME can rewrite the rules in the middle of a squeeze to protect systemically important participants, there is zero reason to believe COMEX would hesitate to invoke force majeure or implement position limits or suspend delivery altogether if the alternative is allowing a cascade of defaults across the bullion banking sector. The technical breakout at $65 is not a buy signal or a sell signal. It is a jurisdiction signal, a warning that the market is transitioning from a regime where price is determined by futures contracts and managed by banks to a regime where price is determined by physical availability and controlled by whoever owns the metal outside the banking system. And that transition is never smooth, never linear, and never telegraphed in advance by technical indicators or analyst reports. So here is what this means for anyone over 40 with a retirement portfolio, a pension plan, or savings in dollars. And I am not going to sugarcoat this with caveats because the data is unambiguous. The silver market is in the early innings of a forced repricing that will cascade into adjacent markets whether you are paying attention or not. And the reason this matters, even if you have no intention of buying silver, is that the same fractional reserve leverage that is breaking the silver market also underpins the gold market, the treasury market, the mortgage-backed securities market, and the commercial real estate debt market. And when one clearinghouse admits it cannot deliver on its contracts, every sophisticated investor begins to ask which other clearinghouses are operating on the same assumptions. The withdrawal of 33 million ounces in 1 week is not a liquidity event. It is a trust event, a signal that counterparties are no longer willing to accept paper claims as equivalent to physical possession. And once that preference shift begins, it does not reverse until the system reprices or the system breaks. The institutions that moved first, the sovereign accounts and central bank proxies that demanded delivery in January, are not acting on speculation. They are acting on information about supply deficits, export restrictions, and industrial demand that has not yet been fully reflected in public data. And when China announced export controls on certain silver compounds in December, that was not a trade skirmish. That was a declaration that silver is now a strategic asset subject to national security considerations, the same category as rare earth elements and semiconductor-grade silicon. And when Elon Musk posted on January 15th that rising silver prices are not good because silver is needed in many industrial processes, he was not offering investment advice. He was signaling that Tesla's supply chain is under stress, and the company is facing input costs that cannot be hedged through futures contracts because those contracts no longer offer reliable access to physical metal. The analysts at Bank of America published a forecast in early January predicting silver would average $56 in 2026 with a peak of 65. And by the time that report circulated, silver had already breached 65 and was trading above 80, which means the research was obsolete before the ink dried. And that is the definition of price discovery, when the market moves faster than the models can calibrate, when historical correlations break down, when technical resistance levels are obliterated in a single session without any corresponding headline news. That is the market telling you the old map is no longer accurate and you are navigating by dead reckoning. The practical question is not whether silver goes to $100 or $150 or $200. It is whether you are positioned to benefit from the repricing or to be on the wrong side of the leverage when the clearinghouse makes a margin call at 3 in the morning and your broker liquidates your positions without asking permission because the risk management system flagged your account as under-collateralized. If you are holding paper silver in an ETF or a futures account, you need to understand that you do not own silver. You own a contractual claim on silver that is only as good as the counterparty's willingness and ability to deliver, and in a genuine squeeze, the counterparty will always choose its own survival over your contract rights, and that is not cynicism. That is how clearinghouses are legally structured, with waterfall provisions that allow them to mutualize losses and override individual claims in the name of systemic stability. If you are holding physical silver in your possession or in an allocated vault where you have serial numbers and insurance, you are outside the clearinghouse system and therefore outside the repricing risk, but you are inside the volatility risk because physical silver does not trade at the COMEX price anymore. It trades at whatever bid you can find locally. And depending on your jurisdiction, that could be a 30% premium or an 80% premium or no bid at all if dealers decide the volatility is too high to quote. The overnight session on January 29th, which few retail investors even knew was happening, saw silver futures drop from $118 to $79 in less than 4 hours, a 33% collapse that triggered the largest single-day loss in silver's history, and the mainstream financial press attributed the drop to profit-taking and overbought conditions. But the traders who were awake at 2 a.m., watching the order flow, knew exactly what happened. A systemically important institution received a margin call it could not meet and was forced to liquidate its long position in size, dumping contracts into a thin overnight market with no underlying bid support, and the futures price cratered while physical dealers in Tokyo and Dubai barely moved their quotes because they understood the crash was a paper event, not a supply event. That dislocation lasted less than 12 hours before silver rebounded to the low 90s, but those 12 hours gave you a preview of what the next 6 months will look like. Violent intraday swings that have nothing to do with supply and demand fundamentals and everything to do with forced liquidations, margin calls, and clearinghouse intervention. And if you are trading silver on leverage or trying to time the market with options, you are playing a game where the house can change the rules mid-hand, and your stop-loss orders may not execute at the price you specified because the market gapped through your level before the exchange could match your order. The signal to watch in the next 48 hours is not the price. It is the inventory data published by COMEX every afternoon showing how much silver remains in registered vaults available for delivery. And if that number continues to decline at the pace it dropped in January, we are looking at a scenario where the exchange runs out of physical metal to deliver against open contracts, at which point the rulebook goes out the window and we enter a negotiation phase where cash settlements are imposed, position limits are enforced retroactively, and the entire derivatives market reprices based on political decisions rather than market clearing prices. The second signal is the lease rate, and if that 1-month rate pushes above 7% or spikes into double digits, it means the bullion banks are in acute distress and willing to pay any price to borrow metal for a few weeks to satisfy delivery obligations. And historically, when lease rates go parabolic, it precedes either a short squeeze that sends prices vertical or a forced closure of the market to prevent defaults. The third signal is the premium between physical silver in Asia and futures prices in New York, and if that spread widens beyond 100%, it means the paper market has completely decoupled from the physical market, and you are watching two separate assets trade under the same name, one that exists as a ledger entry in a clearinghouse database, and one that exists as a bar in a vault that you can touch. And those two things are no longer interchangeable, no longer fungible, and no longer governed by arbitrage. This is not a prediction about where silver is going. It is an observation about what has already happened, about a technical level that was crossed in January when the market discovered it had sold more silver than it could deliver, and the scramble to cover that gap is not over. It is just beginning, and every participant in the financial system, from pension funds holding commodity ETFs to regional banks with derivatives exposure to manufacturers relying on silver for production inputs, is now forced to participate in a repricing that no one wanted and no one can stop. The entities that understand this dynamic have already moved. They demanded delivery, they withdrew their metal, they paid the premium in Tokyo, and they are sitting outside the clearinghouse system waiting to see who gets caught when the music stops. And if you are still holding paper claims, assuming the system will honor them at par, you are betting on the integrity of institutions that have already demonstrated they will change the rules when their survival is at stake.